I'd just like to welcome you to Forum 2A, which is in-house versus outsourced investment management. My name's Kate Wood, and I'm the chair of Care Super, which doesn't have in-house investment. And I'm also a director of AIST, so welcome to the session. We do have a polling question, which I might put the first one before I introduce the panel to you. We've got a panel to discuss this today. So the first polling question is up. This is good. I can read my things and now I can't read the screen. That's going to be challenging. Okay, so those of you, hopefully you've downloaded the app and you can respond to the question through that. So we're looking for what is the minimum level of funds under management that a super fund should have before it undertakes direct in-house investment. So we're getting some responses in there. Okay, so where have we ended up down there? People are looking at between 10 and 30 billion.
Right,
yeah, it looks like the consensus, and certainly above that. So that's your starting point, and quite interesting. I'm on the cusp, clearly, with Care Super, which might be one of our questions, whether this is inevitable. We also have another question, which we'll put up now before we go to our speakers, and that is, okay, what is the greatest risk superannuation funds will face in the next 5 years regarding direct in-house investment? So if you can get your apps out and start responding to that, it's whether it's, well, there's a few that aren't even rating there in terms of illiquidity, rising interest rates and regulatory interference, which is an interesting expression in itself. I'd say the outstanding winner already is attracting and retaining talent, interestingly, and then followed by governance and/or potential conflicts. So that's one for our panel to perhaps bear in mind.
Okay, so a couple of topics I wanted to cover here. The cost imperative. I think there are some good reasons why people should consider insourcing. And I've used this term a couple of times before, the punctuated evolution of insourcing. So around the world you do see people doing different models. And some of the pitfalls, and then put forward what I believe is a sustainable model. As funds grow, and we've got some very big funds represented here at the right. As funds grow, they generate benefits of scale. The question is, how do those funds harvest those benefits of scale on behalf of their members? That's the difficult thing. Now there's a number of different ways. You know, negotiate fee deals with managers. Yes, okay, you can get cheaper deals. You can demand more from your counterparties. You say, well, we're giving you these money to manage, and what we want you to do is to give us some more services, or provide more input into our process. Co-investing is something which is well known in the private markets, but I'd say co-investing also sits in the public markets, like the emulation programs that some people use. They emulate the portfolio that's been generated for them. And then, of course, managing assets internally. Now, if you wanted to try to negotiate fees reduction with an investment manager, the investment managers typically, well, that's how they generate their scale. They're getting scale benefits. It doesn't cost them twice as much to manage twice as much money. So that's part of their business model. But importantly, from their perspective, from their business risk, they would prefer to have 10 $500 million clients, typically, 10 $500 million clients to one $5 billion client. Because if they've got one client who's $5 billion, that client moves, then that might cause a hole in their business. Now, of course, if it's someone like Vanguard with $3 trillion or $4 trillion, it probably doesn't matter too much. But typically when you're dealing with these people, trying to negotiate fees is something which is a difficult task. And it is important, there's some big numbers. So the fees to external managers, if you're paying, say, 25 basis points per annum on a $50 billion fund, that's $125 million. Now, as Kate said, I've just announced my retirement from Sunset. I'd probably come out of retirement for $125 million. But, you know, it's true that payments of that size can attract a lot of talent, right? So it's imperative, the cost imperative means that for super funds, as they get bigger, they should at least consider insourcing. But as I said there, it can't be all about cost. You think about it. You've got an internal team that you are paying them less than what it costs you to get those same services from outside. How can that be sustainable? You've got a group of people there, you're paying less than what they can get on the open market. Either that team is really good or really bad. If they're bad, you've got all the problems of dealing with that. That's a horrible problem to have. But if they're very good, then someone like Treasury Group or Perennial or Pinnacle or someone like comes and taps them on the shoulder and says, you know, you've got a really good track record there. Why don't you come out and we'll help you set up your own business? And looking back, I mean, my first investment job was with Government Insurance Office New South Wales, which was a public sector authority. We had lots of people being taken out. This is in the 80s, 1980s. Lots of people being taken out. There's a guy that used to work for me who was, you know, quite talented, but he was poached away. He was getting 3 times. He was working for me, and he got 3 times what I was getting when he got poached away. So, you know, that poaching process will happen, and it's going to be very difficult to maintain the team if you're doing it purely for cost. So in fact, what I've said there is if your main objective is to control cost, probably mediocrity is what your goal should be. Not too good, not too bad, because you won't actually get that sort of pressure on the team. Now, it's also true, though, that there might be other reasons. It might not be just for cost. It might be for alignment, it might be for capacity, those sorts of things. That's a different question. That is a different question. And when you look at around the world, you do see that there's different motivations for insourcing and that people have done different things. Now, the interesting thing is I've written down here, most do so. In fact, around the world, I only saw people who were defined benefit funds doing insourcing. And they did it because, well, the defined benefit funds internationally are much bigger. The big funds tend to be defined benefit funds. So most only did it for defined benefit funds, and that's size, but it's also because it made more sense to tailor for those funds. Eventually, most, in fact, all of the ones that I saw did eventually set up a separate company to handle the investment management process. And I've said there, just looking my observation around the world, I think that Australia might have the biggest defined contribution funds in the world that are doing insourcing. When I talk to the funds who did defined benefit insourced, and you talk to them, well, you've got DC funds there, you've got defined contribution funds there as well, why don't you do the same thing? Oh no, too much liability. They sort of stepped right away from doing anything on the DC world, which is, you know, quite interesting. And I've called this thing here the punctuated evolution of insourcing. When a fund starts, typically you have a board of trustees, you have some sort of governance structure. The first thing they do is hire a consultant to help them go through this process. You set up some sort of program, and eventually they say, well, we can probably do better if we get an internal person. So, you know, they get an internal investment manager or a CIO or something like that. You've got a manager of managers program going on. Each one of these steps is logical at the time it's made. So then you have internal assets. You say, well, we can do some internal management. Eventually, you separate the company, and then you finish up with what I've called a modified manager of managers. Now, the interesting thing is some of the examples that you see across the globe, you don't even have to look outside. If you look at the State Super of New South Wales, really interesting, because when I was managing money in the 80s, State Super was also, you know, had an internal investment team. And they had some very talented investors. They had Peter Cooper, they had David Paradise. They had some really good investors operating for that particular company. So eventually what happened was they were losing staff. So they set up another company called Axiom. And then Axiom was sold to Deutsche Bank with the contract to manage money. And then State Super now have gone to such a situation where they're now hiring people internally again, and then they've done the whole thing with New South Wales Treasury Corporation, so I'm not quite sure where it's going to finish up. But, you know, it's an interesting case in that you've sort of gone full circle in that particular company. Same sort of thing with British Telecom and Hermes. British Telecom set up an internal team, but eventually became Hermes. Hermes was managing money for British Telecom, and then they took outsourcing, they were managing money for other people. British Telecom eventually said, this is so far removed from our business that they put people back in the trustee office. So they hired people back in. And you can see the sorts of things, every decision that's being made is logical, but when you take what I've called the helicopter view, effectively what you're getting back to as a manager of managers, it's just that you might own some of the economics in one of the managers. Some of the pitfalls that you come across in these sorts of things. Well, first of all, when I've said applying the same diligence standards. And the same, I've said, you know, the same means both not too little and not too much. Quite often, if you're in a monopoly position, or if you sort of, if you're in a monopoly position and the trustee said we're going to give all our money to you, what you get compared to is not the best of what's out there. You get compared to the best imaginable. And that's a really tough thing to have. Because, you know, the people in the trustee board say, well, you know, all we want is above benchmark performance in all environments over all time periods, and we also want it in all environments. You know, if the markets go up, we want you to be ahead of them. If the markets go down, we want you to be ahead. We want you to be ahead all the time. And that's what they're comparing you to. They're comparing you to the best imaginable rather than the best of the competition. So as I said, applying the same diligence standards or the same standards is very, very difficult. But the governance standards, the independent monitoring, the staff retention, I think is really something which is going to be tested. And it got tested in the 80s when we had the floating of the dollar, you had the liberation of the bond markets, you had a lot of deregulation coming through. There were 43 banking licences granted. You had people basically coming in and say, where are we going to get these staff from? And they got them from the insurance companies like GIO and other people who were sort of a little bit sleepy. But the other thing is, what happens if you get to the decision that where you should terminate that manager, you should terminate your internal team? Now that's a tricky thing too. So what I've put forward here is a sustainable model. I've said modified manager of managers through a separate investment company. Through that mechanism, you can participate in the economics. You separate the governance issues because then you have a group which is going to be governed through a proper board, like a board designed for investment management. And the other thing is you can walk away if possible. And I've said there, establish or buy. You know, there are some great investment managers in Australia that have got some good processes, they're good people, and they've got reasonable performance record, pretty good performance record, but they haven't got the marketing or they don't have the market. So why wouldn't you just go along and say, well, you know what, we'll just take that lock, stock and barrel and we'll just set that up as a separate company, or use it as a separate company. So that model, I think, that model is sustainable. It also gives you the option at some stage in the future of saying, like State Super did with Axiom, you know, we might sell that to Deutsche, we might just get a lot of money in there. Could treat it like a private equity investment. So that's all that I had to say today for this bit. I obviously have to have a disclaimer up there. Is there anyone from ASIC in the room? This is general advice. It's not specific to your circumstances, and it's not necessarily of Sun Super or anyone else. Thank you.
Okay, over to you, Richard.
Thank you, and good morning, everyone. What I thought I'd do today is just share with you a little bit of our journey at First State Super. We've grown very rapidly over the past 5 or so years, from being less than 20 billion, and as a result of a big merger, getting towards 53 billion and beyond. And we've had to think hard about all these challenges. And before I start, I want to put in your minds the fact that when you see a topic like insourcing, we're all automatically drawn to think about active Australian equities management or direct ownership of infrastructure and property. And I guess a theme running through the words that I'm going to talk about today is that oils ain't oils, and that insourcing actually could mean very many different things for different people. So let me give you a sense of how we've thought about this. And we wanted to start with actually really understanding what are the core problems that we're trying to solve, some of which David's already alluded to. Cost is an issue, but cost is actually the symptom, if you like. And one of the major problems that David already talked about was the fact that as funds have got bigger, the scale benefits that should be accruing as a function of their size haven't been flowing back to members. And you can see this in the fact that fees at the fund level just haven't been falling, despite the fact that fund sizes have been growing. And when you think about it, the business model of funds management is largely a fixed cost base and a variable revenue base. So that's where the scale benefits are largely accruing. In a typical outsourced model, you have variable costs, variable revenues, and you're really not able to pass them on sufficiently back to members. So let me step back. There are three fundamental challenges that we identified. The first was that one that David's spoken about around scale benefits back to members. The other two are interesting as well, though. The second one is about agency risk. And agency risk is very material. When you think about it, between the member and the end user of the capital, you know, the management team that builds the widget in the factory, there are around 7 or 8 layers of intermediaries. And each intermediary is not necessarily acting badly, but certainly the objective of the member is marginally distorted every time you go down that chain. We are intermediaries, we are agents, just as boards of trustees are. But when you get down to consultants, managers, brokers, boards at the company level, every time you go down one of these steps, there's a little bit of distortion to the ultimate objective of the member, and that leads to a material leakage, in our view, to the returns that are due to them. The final one is about information asymmetry, and this was something that I didn't fully appreciate before I came over to the asset owner world. And a typical multi-manager or manager-of-manager model is very, very distant from the market. And that leads to basically a significant lack of knowledge and understanding around the real dynamics going on every day in the markets. And I'm not talking about just trading, but I'm talking about liquidity, flows, companies looking for capital, all these sorts of aspects that when you are very remote from the market, you really don't get to see. And it became very clear to us, we were looking at a particular property transaction, and we were looking at it through 3 different lenses. In one sense, we were in a pooled vehicle that was looking at buying this property. In another sense, we were on the investor advisory board of that pooled vehicle. And in another sense, we were looking at it as a co-investment. And we saw 3 different amounts of information on that same transaction. And it became painfully clear to us that as a sort of a naive unit holder in the pooled vehicle, there was a lot we didn't know about that particular transaction and the objectives of the agents and the way that the deal was conducted. So those are the problems. And now, as David alluded to, there are a number of ways to deal with those challenges, and insourcing is only one of them. You know, structuring mandates differently, co-investments. There are a lot of different ways to actually deal with those challenges. But insourcing is clearly one of the main ways that you can do it. In our mind, what we're trying to do is give ourselves options and flexibility. If I go back 5 years, we had no option to express an investment idea except by appointing a fund manager and going through those 3 challenges that I mentioned before. So at the bottom of the GFC, when AAA rated residential mortgage-backed securities were trading at 600, 700 basis points above cash, and we wanted to take advantage of that, we had to identify a fund manager, appoint them, tell them what securities to buy, pay them a fee for the privilege of doing this. And it took a number of options out of our kit bag. So if you think about it, there are pooled vehicles, there are IMAs, there are co-investments, and there is direct. The way we see the world is we're going to be using all parts of that spectrum, and we're going to need relationships with fund managers and directly to the market as well, because ultimately that's going to deliver the best outcomes for members. So when we started to think about what capabilities would we want to have internally, we asked ourselves the question of what core competencies sit best in an asset owner landscape. And if you think about a spectrum, on one end of the spectrum you've got strategic asset allocation, and on the other end of a spectrum you've got high frequency trading. Clearly, there are certain capabilities along that spectrum that should be the core competency of an asset owner, and certain capabilities where, for remuneration purposes or cultural purposes or technology purposes, should actually be outsourced. So we've biased ourselves towards thinking about what we call internally, and you'll have to go on a stretch with this, we call it exposure management. And in our mind, these are the competencies that only us, in our position of seeing the whole fund and understanding the member outcome better than anyone else in the value chain, are in the position to actually manage the exposures of the portfolio. So the sorts of things that we are evolving our capability to be able to do are things like active asset allocation, are things like being able to execute on systematic betas where we can tailor portfolios around different risk factors and complement alphas and other sorts of return streams that we get from external managers. Things like strategic investments directly in equities or infrastructure or property. Again, being mindful that we still need that whole spectrum of advisors and supporters, from fund managers to brokers to banks and the like. And the way we've thought about it is, it's not about alpha. It's about tailoring a portfolio that delivers the best outcome for members and doing the things that we think we're in the best position to be able to do. If you think about it, outsourcing active asset allocation is an incredibly challenging idea to do, because frequently the right thing to do might be absolutely nothing. So frequently the right thing to do might be to sit at your strategic benchmark, but if you're paying a fund manager and you've outsourced that capability, it's very rare that they're going to tell you, well, look, we didn't do anything this year because we didn't think it was appropriate. So that's a capability that makes a lot more sense to have internally. And because we have the perspective across the entire portfolio, we can actually do it a little bit better as well. So I'm going to wrap up there, but I guess the key takeaway is insourcing can mean many different things. The approach that we were taking is, how do we deal with the fundamental challenges of scale, agency risk, information asymmetry, by giving ourselves the options and the capability to get closer to the market in the areas where it makes the most sense. And in our perspective, that's about tailoring the exposures of the portfolio as well as we can. Thank you.
Thank you. Now, Peter.
Thank you. So when Australian Super started looking at this issue, it was a few years ago. We were around $40 billion, and we were looking at what the fund might look like in 5 years' time. So we projected out we were going to get somewhere around 120 billion over that 5-year period. And that sort of meant that we'd have somewhere around 25 billion in Australian equities, give or take. And going back to David's earlier point, we knew that external managers didn't want to take much more than $2.5–3 billion in a single mandate. In fact, some will actually start to ratchet the fees up once you get into those areas. So that meant we would have something like 10 Australian equity managers. I know there is a view you can never have enough managers, but the analytics says that if you've got 10 Australian equity managers, you will end up pretty close back to the index. So we would be paying active fees and getting a passive sort of outcome. So for us, a lot of the driver was around the growth of the fund, the strategy of the fund to exploit the benefits of scale, And that led us to look at also how were we going to get access to capacity in active management strategies. So when we looked at the unlisted space and we looked at the amount of money that we wanted to put into the unlisted asset classes, you know, giving money to a manager into a pooled fund, and then that manager chops it up into little bits into underlying investments, meant that we continued to diversify out the portfolio. So at the moment, with around 8,000 line items within the portfolio, we're probably pushing the benefits of diversification a little bit too far. So getting large amounts of money away into meaningful assets that we wanted to hold in the fund was very important to us. Then finally, it was going to give us the ability to take the next step down in reducing the costs to the underlying members of managing the portfolio. So when we projected out of where we thought the fund would grow to, we saw that we were basically going to be paying out around $600 million a year to manage the overall portfolio. And that's a fair bit of money that allows you to think about getting David back out of retirement, and probably a few other people with him. So for us, we then said, okay, that's the sort of parameters of we're looking to get access, we're looking for capacity, and we want to lower costs. Hence, we went down the process of looking at our asset classes, and that said to us, we have a problem with Australian equities getting access to capacity for active management. So that was first off the rank for building out capability. We also we looked at how much we were needing to put away in property and infrastructure, and we looked at the costs of getting that done externally, and that one made sense to build out the capability to do direct property and infrastructure internally within the fund. So, you know, you look at what you spend in your portfolio and it shows you where the big buckets of cost are. So unlisteds was expensive for us. Then it was global equities was the next area, which was a significant cost within the fund to manage the assets. And once again, even on the global scale, the external managers aren't looking for much more than that $2-3 billion in a single mandate from us as a super fund. So the idea that the global market is a lot bigger and hence you can exploit your scale and get a better outcome, we saw down the track that was also an issue. So we're in the process now of building out the global equity capability and putting the portfolio management team together. We looked also at the implementation options that David was referring to, and we found that having that ability to be able to execute an idea quickly and efficiently across the investment options, once we'd built out the internal capability of execution in other areas, just gave us enormous flexibility in how we could get our ideas into the portfolio. It's also given us the ability to think about the portfolio differently, and the thing that surprised us the most was the speed at which the opportunities started to come to us once we had sort of hoisted up the flag and started to interact directly with, I guess, the street and other entities that were looking for capital. So that was an area we had it in our original plans that we would get some benefits around this, but the speed that those benefits came to us has been quite incredible. So when we basically set up the Australian equity capability, it was our most expensive Australian equity manager at roughly a bit over 50 basis points to manage that portfolio. So getting back to Richard's point of funds management as a fixed cost game, As we scaled up the size of that mandate, that active Australian equity mandate, we're now running for around 9 basis points on a fully costed basis for allocating all the costs of running that portfolio. As we bring global equities on stream and as we've brought our small cap capability on stream, that's just going to allow us to spread some of the fixed costs of platforms and infrastructure, further lowering the cost of the Australian equity team and those other teams. So the fixed cost nature of funds management really does allow you to scale and get some pretty substantial benefits of building an internal capability. And in fact, when you do the numbers and you show those numbers to anybody about the benefit you're going to deliver, no one believes it because it is just so overwhelmingly large, the ability to deliver savings and benefits back to the end member. So we found that putting in the capability had a number of things that we hadn't expected. One was the speed that we were requiring to do things differently to the rest of the organisation. So we found that when we looked at what we needed for, say, an IT platform, what the fund was running on at that stage wasn't going to cut it. So we went out and put in our own network to allow us to run the systems and capabilities that we needed. The speed that we started to take on staff stretched the HR and recruitment capabilities. So the actual stresses and strains we put on other parts of the organisation was an area that we hadn't fully planned for. We also, the impact on the governance structure within the organisation was also an area where we needed to move to start to change that and drive the delegations from the investment committee down into the investment team to match up with what we were doing. One of the questions that we had earlier up on the screen was, is there a risk around governance and conflicts? That was another area where we hadn't expected the speed that we were going to have issues around some of those, where you've got publicly traded assets, you've got teams doing things with listed companies and talking to them about opportunities. We now lock Mark Delaney away because he can't talk to anybody else because he knows too many things that's going to conflict him somewhere. So that area was also an area which we hadn't anticipated happening as quickly. And then we found that there are a whole lot of operational issues which, once we started doing it for our internal portfolio, we then looked around and said, well, if we're doing that for the internal guys, why don't we start doing that for some of the external managers? So we've started doing a number of things where we're centralising our external managers onto almost a platform of this is how we want you to clear your futures, this is how we're going to treat any surplus cash in your portfolio, and a range of things there where we're just bringing back a lot of the scale benefits that we've dissipated by cutting the portfolio up into these little bits and handing it out to everybody. So we've seen a number of benefits back to the members from doing a range of, we call it picking up the crumbs off the table, which just keep adding up to millions of dollars, and as the fund gets larger, they just keep on providing benefits back. So that's really, for us moving into internal management, it was part of our strategy of this is where we're going. Being fully a manager of managers was not going to allow us to achieve the outcomes we were looking for our members, and hence we started transitioning into this hybrid model of having internal capabilities and continuing to use external managers as part of the overall investment platform.
Great. Thank you, Peter. Just to remind you, we do have a good 15 minutes, I think, for questions. So if you want to text them through the AXA IM Q&A is open. We've got a couple up on screen, but you can also raise your hand if you wish to ask a question. That wasn't a wave. I'll just ask a first one, which is, I find it interesting, David, your helicopter view, which is saying, well, it's sort of happened before and this is what's resulted, which is, you know, hiving off a company and then it ends up being sold and then you start again, potentially. And there was another issue too about liability in your presentation, that overseas they've been more comfortable to do it in a DC environment, but where it's...
DB, yep.
DB, I mean, but not so much in a DC. I'm just wondering if the panel can comment on, well, those who are going down that path, has it been planned to the point of there being an end vision of how far you think you'll go or won't go, or, you know, do you see yourselves ending up with a separate company, investment company, or not?
So we had that discussion up front about, do we put it into a separate company? Do we keep it within the organisation? Do we put them in a separate building? All those sorts of issues. And where we landed was we wanted to keep the internal capability part of the trustee company, because we felt as soon as you put it into an external entity, then you start introducing the whole agency risk, that organisation goes, oh, we've only got one client, we better go and find some other clients, and you go down the road that David talked about. We also wanted it within the investment department so that we had that cross-pollination of ideas, and that we could bring people together from the equity team, the infrastructure team, or the property team, the fixed interest team, to look at a specific opportunity. And we've found that to be absolutely invaluable, of looking at an investment opportunity from different lenses, and some of the synergies and benefits that we've seen occur from that have actually been far in excess of the returns that we've seen from actually having internal management capability.
Do you get any sensitivity? Sorry,
go for it.
Do you get any sensitivity from external managers thinking there might be a bit of a flow of information that's, you know, from their intellectual property sort of being shared with someone who's effectively competing with them in the capital markets?
We've certainly set up our structures and processes to quarantine all the external manager information, portfolio holdings, their reports, everything, from what the internal team can see. So we've got all the information barriers around that. Though if you go off and talk to a number of the funds offshore who are running this same sort of hybrid model and have been doing it for a longer period of time, they actually talk about they now have the situation where the external managers come in, talk to the internal team, and it's a much freer and open discussion around stocks and issues that are going on in the market. So we've certainly taken the position of firewalling everything, but I'd like to think down the track we would see that ability to be able to potentially reduce some of that and get a much better integration with the external managers.
From our perspective, if you think about our logic, it doesn't really make sense to spin things out into a separate company for a bunch of reasons. The first is that if I go back to my information asymmetry point, then once again you're distancing the trustee office from actually what's happening in the market, and you end up with the same sorts of challenges. The second thing, and this is definitely to the heart, I think, of a lot of what Peter talks about, is what's very important is a one portfolio mindset. And it's the integration of information across different teams, which is of course very difficult to do, as anyone in funds management knows. But that's where the benefits ultimately accrue in a very significant way. The final thing, though, is about if what you're trying to do here is create an environment where, let's say, active management is likely to prosper. And if that environment is such that it needs to have its own space, it needs to be culturally distinct from the environment in the asset owner, the systems need to be different, all those sorts of, the motivations need to be different, the remuneration needs to be different. Well, that, by our logic, starts to push us towards outsourcing rather than insourcing. So our way of thinking is that it's actually the stuff we want to have the capability to do is the thing that actually makes sense in the context of an asset owner. And once you start pushing it away, well, then it starts to look more and more like a funds management business.
Okay, we've got a question here, really to Peter and Richard, in terms of David's point around staff retention and competing from a pay perspective with the external market. And I guess I'll add to that one that people in the lead up to this often say, which is, how do you sack them if they're no good?
Thanks.
Well, it just works more for an active approach.
Yeah. Okay, so on the attracting the talent, so we've had no issue in basically attracting the Australian equity large cap team, the small cap team. We're building out a global equity portfolio management team based in Melbourne. We've got infrastructure specialists, we've got property specialists. You look at the people we have in our asset allocation macro team, we've attracted people from the other side of the world to join those teams as well. So the ability of being able to find the people to come and do the roles has not been a problem. It's taken a bit longer than we would have liked, but you know, I'm amazed at the number of people who've moved from the other side of the world to come and join the fund. We've had to change the remuneration policy and framework within the fund to accommodate this, but that's just part of the ongoing development of what is happening within the fund across a number of areas. So, yeah, we've had no issue on the retention. On the sacking them, yeah, they had a bad day yesterday, they've all gone. And there were some tears, but, you know, I'm over it now. So the process we would apply in relation to that would be the same as we apply to an external manager. So we don't wake up in the morning and decide to sack an external manager. The external manager would have been on watch. We would have had discussions with that manager. We would have understood, is their style just not conducive to what's happening in the market? All those sorts of issues. So that is the process we would
But
go
isn't
through.
it a lot harder when you're saying that some of the benefit you're trying to derive is actually some integration across these teams with the rest of your investment, you know, management capacity? So then they're part of the gang, really.
And remember, you can just sack a person. I mean, you can. It might be an individual. It might be part of the team. It's a different mentality.
Yeah. But there is certainly that element of what are they doing within the portfolio? How's that portfolio going? What are they actually contributing to the broader asset class and the other things we're doing across the fund? So it would be like any other performance discussion with a person in the fund who's not meeting their objectives. So, you know, within the investment department, Australian Super, if you're not up to it and doing what you're supposed to be doing, then you're not going to have a long future at the fund.
I won't claim that from a trustee perspective I've observed great rapidity in you know, sort of quick response in sacking managers. So that's true, but that is, you know, that whole review process is an uncomfortable one when it's internal, I would imagine.
Yes.
Just a couple of, it would definitely be, a couple of thoughts on this. Firstly, it comes down to what you're trying to achieve. So if you're going for, you know, a high alpha, very concentrated portfolio, you know, a hedge fund style portfolio, clearly, you know, it'll be demanding to actually meet what an individual who's highly skilled at that could probably earn in the rest of the market. And as I've argued, that's probably not the right place for them to be. However, if you're looking for strong fundamental analysts and you're trying to ensure that you have a good perspective on the total market and you're trying to incrementally add a bit of value against the benchmark, potentially it's a little bit different. But the way we think about things, because of course it's not all about pay, we've got this saying, the green, the grey and the grounded. And it's basically, you know, as many of you in this room know, there's a palpable sense of purpose when you're working in the not-for-profit sector. And you know, you have a direct line of responsibility to your members, and frequently you get very talented people who are either very young, looking for opportunities, they're green, they've delivered in their career and they're looking for something more meaningful near the end of their career, or they're just very grounded individuals that actually are looking for a different type of perspective. So I think clearly going after you know, a hedge fund manager is not going to work in an asset owner context.
I think you have to be very careful about the culture. You know, if you got the wrong... Sorry? So I think you have to be very careful about the culture. If you appoint the wrong sort of people into the team, then you're going to have a lot of tears down the path. I mean, you might get some good performance out of them, but then they'll get tapped on the shoulder and they'll be pushing. And you know, this is exactly what happened at GIO, and it's what happened at I understand happened at State Super. I mean, they had some very talented individuals there, and it just wasn't sustainable. And you know, so appointing the people with the right culture has the potential to give you a robust, sustainable team, but it's only potential. And at some stage, you know, money can talk. I mean, if you get a really good team there that's doing some wonderful things, you know what? Someone will come along and offer them a very, very attractive offer to move out and set up their own business.
Just with another of my hats on, which is from Women in Super, given that investment management is notoriously underrepresentation of women in that sector, I'm wondering how Aussie's going in terms of building up the team compared to the sector more generally.
Yeah, I wouldn't say that we're leading the way on changing it at this point, but we are certainly, we've brought in senior women in the property area, infrastructure, fixed interest. We've also got an active graduate program where we are getting a much better gender diversification on that to bring those through. So it's an area that we are conscious of and have a number of strategies in place to address.
Okay. I haven't seen anyone waving, so I've not been ignoring you if you have been. Just maybe one last quick one, which is there is the question of performance monitoring and how it's disclosed to members. Do you see that as an issue, that there should be any distinction?
So actually separate out the internal team's performance and let people know.
I think that's what the question's getting at.
I mean, it's an interesting question because even internal, I mean, I imagine even internally, if you've got an internal team that's performing very well, that's one thing, but if they're performing poorly, that has the risk of contaminating lots of aspects of the business, because you know your marketing people are out there saying, well, our performance is not as good as other people or whatever because you know we've got this internal team which has got a bit of underperformance. That's a difficult stress to put on the entire organisation. Probably it may not have happened just yet, but I can imagine that inevitably, if you're doing active management, there will be times when you're going to have underperformance, and it's going to be interesting to see how mature the fund is to cope with that.
I think that's exactly right. Look, it is challenging. Obviously, it's got to be monitored in the case of anything, but particularly active management. Disclose to members is a challenging question because there are, I mean, I understand the basis for the question, but you know, that might not be the ideal way to foster the right culture and nature of the actual and incentives of the actual team internally. So that's a challenging one. I mean, I imagine you wouldn't do it. But
no.
Yeah.
Okay, I think we are now out of time. So I would like you to thank our speakers, David and Peter and Richard.